easy in this quarter. In fact, soft numbers quarter on quarter, year on year, of course, the growth was led by a low base and the recovery was led by non-ticketing businesses, which are not margin accretive. So as a result of which, we've seen the margins compress year on year as well. Quarter on quarter, a 5% decline on the revenues, a 5% decline on the EBITDAs have kept the margin stable. But, the net profits declined by about 8%. Now, if you just take a look at these numbers year on year, there's a 99% jump in their revenues. But despite that, the EBITDA has grown by only 44%. So that means margins, which were upwards of 50, 51 odd percent, have now come all the way down to 37%. Why is that? Well, because catering, which was, partially open same time last year, saw a revenue jump of 378 odd percent. 334 crores is what the company did in their catering business revenue. And catering is margin dilutive. Their catering expenses the same time last year were 28 odd crores, and now they've gone all the way up to 235 crores. Ticketing business, which is the more margin, margin accretive business for them, was absolutely flat quarter on quarter, and year on year there was a jump 13 odd percent. But be that as it may, we've seen a decline in Emami's performance on the business that has, grown their margins. Talking about declined performances, we have Emami, which reported a muted set of second quarter numbers, and currently as we speak, the stock is at the low point of trade. The margins contracted. Ebitda also declined on account of increased subsidiary costs, ad spends and distribution expansion. We do have with us N.H. Bhansali, who's the CEO of Finance and Strategy of the company, joining in. Thanks a lot, Mr. Bhansali. Always a pleasure speaking with you. Just wanted to understand, the first half is done. What is your winter offtake looking like? How was the third quarter? You did expect some sort of improvement come by. I mean, in light of that, what can you guide for in terms of full year revenues?
We expect, the winter to be good, and the winter has started setting in. So we are very optimistic on the winter and also on the second half. We have delivered for the first half, despite the challenges, 10% growth for the first half, and we expect the year also to end up with around a double-digit growth in terms of the revenues.
Okay. All right. Sir, I just wanted your thoughts in terms of what the margin picture would now look like for the company. We just had the CPI data that was released yesterday. There was some amount of softening which has taken place in inflation. What is your sense in terms of where input costs stand for the company as a whole? What can you guide us in terms of margins probably in the in the second half, considering that you've done around 24% in Q2?
So the margins had contracted in the first half, but now I think they have more or less stabilized, except for the carryover inventories to very few. We do not expect the margin to reduce substantially from here. In fact, the whole year margin last year had been at around 30%, and we expect the second half to be very good. No further margin, substantial margin reduction is expected in the second half.
Okay, so no further margin reduction expected in the second half. On that note, can you give us a range? Will it be as per the last year's margins, or it'll be some improvement, say 100 to 200 basis points in the second half? And what role would ad spends take place in that regard? Because you have one of the highest in the industry. Will they continue to remain between 16.5% to 17%?
Yeah, we continue to remain buoyant on the offtakes in the second half, and so we would continue to remain invested on the marketing spends, and we expect that to be around that level as it was there in the previous year. And so EBITDA margin would also be in line with what was there in the previous year in the second half.
Right. So, in the conference call, you did mention that margins for this year would be around 27%. The first half, I'm looking at your revenues. Your revenue growth actually overall has been just 4%. So I don't know where that double-digit number you got from. And margins as well, 24.6%. Do you expect to do double-digit revenue growth in this year with 27% margins?
First, that the revenue growth of 4% is for the second quarter and not for the first half. What I said is a 10% growth for the first half. Right?
Okay, go ahead.
So, right. And the 27% margin is for the full year. Is expected for the full financial year.
Okay. I also wanted to speak to you about Dermicool integration. By when is that expected? Because it is the second half when true benefit from Dermicool will start kicking in for you. What kind of contribution will this portfolio make for your business?
Yeah, Dermicool integration, in fact, we were using the rackets distribution till that, and now from this ensuing season, it would get merged with our own distribution, and we expect around 3%, 3 to 4% kind of growth from the Dermicool.
Okay. So, what might your cash on books be? I just want to understand whether or not you would be interested in such kind of strategic acquisitions in probably, in the second half of this fiscal going into next fiscal, because we've noticed a lot of interest in the OTC space specifically. It might be a portfolio of brands, it might be a specific brand. Would that be something on the cards for Emami? Further strategic acquisitions in the Indian space when it comes to the OTC market?
Yeah, very much. See, the three pillars of growth for us. One is growing the core. Growing the core, all the power brands, we are increasing our penetration further, and so that would help us grow our business, growing the core. Then we are always on the lookout for right acquisitions which has a synergistic benefits and which are a strong fit, kind of a Dermicool, or in the past we did the Cash King or a Cream 21. Those kind of acquisitions would continue. And we also, third pillar is the investments. We have made investments in a few startups which has grown along in the last 3-4 years, kind of the man company. So that also that has become a subsidiary in this quarter, and so the cost of that company has also been debited in the Ebitda for the quarter, which you might have seen.
Right. So, we know that you have been acquisitive in nature in the past. You've brought some companies at the same time.
And would continue to be so.
Yes. You recently acquired Furball Story as well. Just wanted to understand, let's flip the question away from acquisition into divestment. There are a lot of non-core assets at the group level which you are looking to divest. There was the non-core land. There was the sale of AMRI to Manipal. I wanted to know how advanced are those talks right now, and by when do they fructify?
So we are working on both processes. So this is a question which is pertinent to the group and not for the FMCG. But since you have asked, and at a group level also, we are divesting on, and it has nothing to do with Emami Limited per se.
Yes,
it does not impact Emami Limited.
The reason why it impacts Emami, sir, is because promoters still have 33% of their stake pledged, right? So we wanted to know by when does that come off. Mr. Goenka here on our channel had said that 30 to 45 days the Amri sale will complete, and after that the promoters pledge will come down substantially. So to that extent it would be important for us to ask, but just wanted to know an update on that.
Yeah, we still maintain that we are very hopeful that the deals we will be able to sell off some of the non-core assets, including hospital, and it would our pledge would reduce substantially. The pledge on the promoters' pledge of Emami shares would reduce substantially from here.
Okay, all right. We'll wait by for any kind of M&A which Emami is going to undertake. As of now, the stock is a little lower. Thanks, Mr. Bhansali, for joining in.